Flip or hold sounds simple, right? Until you realize that one wrong answer could cost you tens of thousands of dollars or a decade of compounding wealth you'll never get back. This isn't a personality quiz. It's math with consequences, and most investors are making this call on gut instinct alone. Here's what's wild. The same property, the same purchase price, the same neighborhood can either be your best flip of the year or your most powerful long-term wealth vehicle. And the difference lives in one calculation you're probably not running. We're talking about a single framework that forces both scenarios to compete on the same playing field. And most people have never even heard of it. The reason investors skip this step isn't laziness, it's that the real estate education industry taught flipping and buy and hold as completely separate religions. One camp is preaching speed and liquidity. The other is chanting cash flow and appreciation. And nobody handed you the calculator that lets both sides actually debate each other with real numbers. Let's set the stage. Imagine you find a property for $150,000. It needs $40,000 in work, and after repair value comes in around $230,000. Your flip profit, after holding costs, commissions, and taxes, might be somewhere around $20,000 to $25,000 exciting, until you do the other half of the math. Now run the rental scenario on that same deal. Same buy price, same rehab, and let's say it rents for $1,600 a month in a market with solid appreciation. Over 10 years, factoring in equity paydown, appreciation at 3 to 4% annually, and net cash flow, you could be looking at over $150,000 in total return. Suddenly, that $25,000 flip check starts to feel a little lonely. The calculation that settles this debate is called the opportunity cost comparison, and it's almost embarrassingly straightforward once you see it. You're simply asking, what does the flip profit grow to if I reinvest it aggressively, versus what does the held asset accumulate over the same time horizon? Then you pick the bigger number. Here's the psychological trap that makes this hard. Flips feel like winning because the money hits your account fast and your brain floods with dopamine, like you just won a hand at the table. Long-term holds feel slow, boring, and emotionally unsatisfying, even when the math is screaming at you that patience is the move. The historical record is pretty brutal on this point. Nearly every documented wealth builder in residential real estate built the majority of their net worth through assets they held, not assets they sold. The flippers who became truly wealthy almost always use flip income as fuel to acquire hold properties, which is a completely different strategy than just flipping for its own sake. There's a common misconception that you have to choose one identity flipper or landlord, as if switching between them is some kind of betrayal. The real move is understanding that flipping is a job and holding is a business, and the smartest investors use the job to fund the business. So here's a practical framework in plain language. Calculate your net flip profit after all costs. Estimate your 10-year total return on the held asset using conservative numbers, and then ask yourself what your flip capital can realistically compound to if deployed elsewhere. Whichever scenario produces the larger 10-year number wins no feelings, no identity, just output. The discipline piece is where most people fall apart, because the market will always be throwing urgency at you sellers wanting quick closes, partners pushing for fast exits, your own impatience dressed up as strategy. Process beats conviction every single time. And sizing your risk appropriately means never betting your entire capital stack on one outcome, regardless of how clean the numbers look. Here's the beautiful irony of this whole debate. The investors who are most comfortable running both scenarios without attachment to either outcome are exactly the ones who make the best decision every single time. Detachment from the outcome is not weakness, it's the sharpest analytical edge you can carry into any deal. Ultimately, the flip versus hold question is really just a question about what you're building, a career or a portfolio, income or wealth, speed or scale. Discipline, position sizing, and consistency compound just like interest does. And the investor who internalizes that truth stops chasing the right answer and starts building the right system. Whether the market shifts toward buyers or sellers, whether rates rise or fall, the investor running both scenarios honestly will always be better positioned than the one who's already decided before the math is done. Rational preparation isn't pessimism, it's the only form of optimism that actually pays. If you want help running these numbers on a real deal, whether you're looking at your first flip, thinking about building a rental portfolio, or need to find the right lender to make any of it possible, check out our links in the description below.